Hello. In this video we're going to go over some very simple Fibonacci rules and basically show the importance of the three main inner levels of the Fib tool, the ones that really matter the most. Is your 38.2 level, your 50, and your 61.8 level. And the reason we refer to this tool as a Fibonacci retracement tool is once you measure a waveform with it, the inner levels, your 38, your 50, and your 61.8, they give you your entry points into the market. Alright, and to demonstrate this, we're going to use two separate Fibonacci tools. One set up as the buying levels or buying points into the market, and the other one set up as the selling points in the market. And it's very simple to set your Fibonacci retracement tools up in this manner. If you go and pull a normal, the basic default, we'll just change this to the default and look at it and go over how to change this. You'll see your basic default tool here. Alright, if you just go to the properties, we can eliminate the levels that we're really not concerned with, that really don't matter. And get rid of all of the extensions here, because we're not really concerned about how far a price is going, because we're looking at entry points, and we basically end up with this. Alright, now your 38 and your 61.8 level, no matter what, if you reverse them, they're always going to come out in the same place. So you can just simply rename these things. It's just all selling points. Until it comes out something like this. And then the ones I have made up, pre-made here, I've already got ones that actually show the price as well. So we'll get rid of this. Alright, and then our starting point is when we see the market making these little waveforms. Alright, now what we're going to do when we set our tool up this way without the 38, 50, and 61.8 on there, what we're doing is eliminating the need to decide on which way it goes, top to bottom or whatever. Because if you swap them around, it doesn't really matter. That's why I say, your 38 and your 61.8, when you measure, a high point to a low point or a low point to a high point, they're always going to come out in the same place. So it doesn't really matter if we turn this upside down or anything, because our levels are going to come out in the same place anyway. But if you think about the name, the Fibonacci retracement tool is after the price has made this high and made this little bitty up movement here, as it begins to retrace, these are the buying points back into the market. If these fail as buying points, the market turns into a short market. And as we see here, from this, measuring this just one little section of price here as it made this move up, as price began to retrace, it kept retracing and actually broke through, and now it's on the short side of the market and we're no longer buying. But this could have been determined long before it broke through these levels. We'll have to zoom in a little bit here. If we go to this point where the market made a high and actually begin to make lower lows, when it begins to retrace, we have three selling points. And now this is coming into a seller's market. And as this is being sold, it's being sold back down into the three buying points or the support points. And once they fail, it's a short market. Now as we continue to make lower lows, you just continue to the next lowest low as you make new ones. When you stop making new lows, price is retracing up into the three selling points. And if you just continue this process out as it makes new lows and rallies up, you can see that it remains a short market, because at the three selling points of the Fibonacci tool, that's where the market is being sold off from, and thus becomes your entry points. Now we have these big runs in price where the market just remains short and starts trending into these really long trends. Alright, if we zoom it out and we just come to the point to where we find the market retracing or moving sideways, we'll bring our three selling points down as we move down with the lows. Alright, now when the market does begin to retrace, it comes up to our three selling points, and as long as these three hold, the market will remain short. And once we've seen this begin to retrace and start making higher highs and higher lows, we would have been following the market up as it made its way to the three selling points. Now as the market retraces, the three buying points catch price. It's enough to continue the push up, and as you continue to make new highs, you continue to pull your buying levels until they fail. We no longer have any more highs to pull to, so we have to stop And then we know as the market retraces, as it comes into our 3 buying points, they fail. Support has failed. The market returns into a short market, just as we suspected from our larger wave here. So now, from this rejection point, as we begin to follow the market down as it makes new lows until it begins to retrace and test our 3 selling points, now we have another entry into the market short. And as this started to make new highs and move up, the market comes up, the 3 buying points take over here, and we get a little buying pressure. But then at the end, the resistance is still strong enough that it sends price, and we have a failure of support again. Now the market begins to move short again. We come to the point it sold off at, broke short, but continued to follow it down, down. Now we no longer have any more lows to pull to. The market retraces up. The 3 selling points come into play. The market gets sold off once again. And as it made new highs, you could have came in to see where are the 3 buying points. As the market made a new high, this day comes out. Buying pressure is there. The buyers are present. Pushes price up into the resistance levels, or 3 selling points. Initially, they begin to hold. The market breaks through. The market moves back into the short side of the market. We come to the point where it began. The market begins to retrace. It tests our 3 selling points. They're still containing price, pushing price to the short side. As this begin to retrace, if we follow our buying points up, we get a little bit of an early signal that this may not last, but we do get actual buying pressure up to the selling points. We get our entry short. We see it come down, test the 3 buying points. They fail. The market goes back short again. So we come to this point. As the market retraces up, you can see the selling pressure as it makes the market wick back down. And initially, the 3 levels hold, but then you get the break long here. And as this was happening, if we get this one out of our way, we can see that the 3 buying levels were actually holding price and supporting it until you get to the point to where price comes back into the 3 levels, or the 3 buying points, the 3 inner levels of our fib tool, and they fail to support again. The market moves back into the short side of the market. And as we move to new lows, the market rallies up. The 3 selling points still in control. The market rallies up. We get just a little bit of penetration. All 3 selling levels. The market rallies up. They fail. The market moves back short again. If we were to follow this movement up, whenever it began to actually move higher, make higher highs, initially it comes up, the next day's out. The 3 buying points contain price. It moves up. No retracement. Now it retraces. The 3 level support or our 3 buying points fail once again. And if you start following price as it makes new lows, no retracement. Now it begins to retrace. Our 3 selling points take back over, our 3 entry points, and the market moves back to the short side. Continues to do so. We come to this point. Now we finally have a pretty strong movement with this. It comes up, actually penetrates, letting us know that if we would have been following this here until we retraced, we can see that our buying points actually come into play and push price up even higher. So we come now to this point in the time to where if the market retraces, we have 3 buying points. And here we are again. If they fail, the market moves back into the short side. As long as these 3 levels contain price and we see it bounce from these points or these three buying levels, we'll continue to push forward or push higher. If they fail, we'll go back to repeating the process of looking for short entries once we make a new low. If the market comes out and makes a new low, these are the three selling points. So there you have it. It's very simple. And that's the purpose of the three inner levels of a Fibonacci retracement tool. If you like this simple strategy, you'd like to learn more, please visit us at bobogus.com. We think we can help you turn your trading career around and actually become profitable and be able to make sense of these markets and their movements. We hope you enjoyed this, and thank you.